All right, let's talk about how to run a portfolio the proper way, which I think is a really important subject we're going to speak about in this video, okay? Listen, here's how a person runs a portfolio. Here's how like an average retail investor, unfortunately, runs a portfolio. They buy a random stock, and then you know what they do? They buy another random stock. They buy another random stock. There's no like strategy or discipline into building and constructing this portfolio the proper way. It's like if you were to build a house, right? You wouldn't just be like, let's just throw some plumbing up and throw some... No, there's like a very specific way you need to build a house, right? We're going to start with getting the plumbing all ready and digging stuff into the ground, and then we're going to pour a foundation. There's like a whole process, right? That process is so important if you're building anything in life. And when people go to build a portfolio, they're not even thinking about process. They're just like buying some random stocks. And I did the same thing when I first got in the market back in 08, 09. I had no clue on how to properly build a portfolio. That's what I learned over the years, right? But I had no clue at first. So what I was doing was I was just, buying some random stocks. Like back then we were going through the great financial crisis, the great recession. I was just buying some random safe companies. I'm like, let me buy Kimberly-Clark. Let me buy Conagra Foods. Let me buy Walmart stock. Let me buy Walgreens stock, right? Like these businesses are like, like they make it through the other side. They're recession proof. And so, that's what I was doing, but that's not the proper way to do it. Okay. And it'd be like, imagine you're gonna have a 100-meter race, right? Sprinting all out, and you're like, let me just move random. Like, let me just go sideways or backwards. Like, it's not gonna work out very well, right? So if you've been through my private stock group over time, right, and you've learned from me over the years, I always preach GVD 1, 2, 3, right? GVD 1, 2, 3. What does that mean? What does it mean, GVD 1, 2, 3, right? This is specific on how to properly build a portfolio. You need to be a well-rounded investor to be able to build a portfolio full of growth stocks, value stocks, and dividend stocks, first and foremost. All three of those are very important. Growth stocks have their time to shine. When the market is very risk on, when the economy is very risk on, man, growth stocks are it. Like they are going to perform tremendous for you, right? In the last few years, it's been growth stocks' time to shine. Growth stocks are brutal stocks to be in when the market's going down. Ask any investor that went through 2022 like myself or anybody else. What happened to our growth stocks? They got obliterated. Like we're talking, those stocks fell 40, 50, 60, 70, 80, 90%, some of them, from their peaks. It was brutal. What comes in handy when you're going through one of those sorts of brutal markets? Value stocks and dividend stocks. Traditionally, value stocks make it through the other side just fine. They don't go down nearly as much. If you need to take some profits out of somewhere, and you're in a major downturn, and let's say growth stocks are really cheap, you can snag some from your value stocks because they probably went down nearly as much. Like there's a ton of value stocks out there that actually didn't even really go down in 2022. They actually went up or down way less than the market went down. Like, you're looking at Shopify stock might have went down 70 or 80%, right? There's plenty of other value stocks I could show you that actually went up during that same exact time or, broke even or so. So that's something to keep in mind, or went down like 10%. And additionally, dividends come clutch when? They come clutch all the time because your portfolio is constantly having money thrown in it, every 3 months, and you don't have to worry about selling. You're just getting this money deposited randomly, right, from these companies, boom, 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 and that snowballs as your portfolio gets bigger and bigger and bigger. My guess is I'm going to make easily 5 figures, if not multi-5 figures this year from dividends. I wouldn't be surprised if eventually I'm making 6 figures a year just from dividend income, right? And so that's a beautiful thing. And then when you're in a downturn, the last thing you want to do is sell stocks. So if you got the dividend income coming from your stable companies, you're able to deploy that at stock prices at very, very cheap prices. So it all works together, man. And it also keeps you like very focused and balanced investor. That's where GVD comes from. Growth, value, dividends. No, you might be in certain markets sometimes and somebody's like, oh no, it's just growth time, right? Listen, man, those value and divs will, if you don't properly allocate to them, it's going to come back to bite you in a major way. And if you're only in value and divs, there's a high probability you'll underperform the market long term, because the growth companies is really what really drives a lot of the returns in the market over time, right? Those companies that really, grow revenues 10% a year, 20% a year, 30% a year, they drive a lot of the returns of the market, okay? So if we look at the public count here, what you're going to find is every stock plays a game. It's either growth, value, or dividend play. Some stocks play multi-games. So if I look at Meta's a growth company, but it's also a dividend payer. So it's a GD. AMD, straight growth. Amazon, straight growth. Celsius, straight growth. Those are all three growth stocks, right? Then we have Nike, which is a value dividend company. Cake, which is a value dividend company. Obviously, we talk about Cake's, tremendous growth opportunity over the next 10 years. But at the end of the day, like Cake, when you really break it down, you say, oh, this is a great value dividend stock, right? Palantir, straight growth. Estee Lauder, value and dividend stock. PayPal, value stock. Elf, growth stock. SoFi, growth stock. Adobe, value stock. Google, value and dividend stock. I know a lot of you guys might not know, but Google now pays dividends, okay? Fubo, growth stock. Honest, value stock. Revolve, growth stock. And the Planet is a spec stock. A spec stock is a company that loses money, essentially, okay? In regards to their income statement. So in spec stocks, you usually want to keep those like smaller size positions. Now, phenomenal. Like that's the way you want to do it. Tons of growth stocks, tons of dividend stocks, tons of value stocks, right? How many stocks do I have paying me dividends? 1, 2, 3, 4. So I have 4 stocks that pay me out dividends every 3 months in this portfolio, right? Or is it 5, right? Wait, 1, 2, 3, 4, 5. 5 stocks that are paying me out dividends. It's beautiful. It's beautiful, man. That's how to properly do it. Now, I'm always going to lean heavier to growth stocks. Why? Because growth stocks, if you're in the right growth stocks, they're life changers, right? If we think about my greatest stocks over time, we had Tesla, which was a 2,000% plus gainer, right? We think about Meta, a 577% gainer, right? We think about Palantir, 2,400% gainer. We think about Elf, 1,500% gainer. So a lot of my very best stocks are growth stocks. You've got to have, if you can find some great growth beasts, like, oh my gosh, like they will change your life. They will change your portfolio's life, right? If I think about NVIDIA over time, right? Monster, NVIDIA and Monster are 2 examples of stocks I just let go too soon. I let Monster run for quite a bit, but I sold it too soon. NVIDIA, sold that one too soon. NVIDIA I sold after I made like 30 or 40% on that stock. Oh my gosh, I should have just held every share of that stock, right? So, there's a difference between making your first 30 or 40% on a stock and selling. And, if you're in a great growth stock, this stock should end up producing you like insane returns, like, 1,000% plus returns if you're in a truly great growth stock. So, something to kind of keep in mind there. I always think about sports, right? And I always get a lot of inspiration from great athletes. And so Floyd Mayweather would be usually respected as the best boxer of our lifetime, right? One of the best boxers ever, but the best boxer of our lifetime. And the thing I learned from him in the way he approached boxing was he was not just some, if we think about like Mike Tyson, like why do we think about Mike Tyson? Like we think about him, he just had crazy power. He was just knocking dudes out, right? But Mike Tyson lost a lot of fights, right? And that's what happens if you're a little bit of a one-dimensional fighter. Floyd Mayweather was great at everything. He was the best defensive fighter likely in the history of the sport. He was great at throwing punches very rapidly, making those punches connect, keeping guys off him, understanding strategy of what punches to throw at the right time, setting up his punches. It was unbelievable, right? And so when I think about how I adapt somebody like his game to my game of stock market investing, that's how you do it. You've got to be great across the board. You've got to be great at picking growth stocks. You've got to be great at picking value stocks, dividend stocks, understanding when the right time to really invest aggressively is, and understanding when the time is to lay back a bit, right? And say, you know what? I'm going to chill a bit right now. I'm still going to do my weekly buys, but I'm not going to invest aggressively right now, right? I'm going to let the market do the work for me right now. I'll let my value and dividend stocks do the work for me. And so, that's just a little piece there. But you want to stay focused on the long term when building on your portfolio. Always remember, you're building a portfolio for the next, 5, 10, 20, 30 years. And so when you're thinking in 5, 10, 20 year time horizons, you think about the portfolio a little differently than if you're thinking about how am I going to build this portfolio for the next 6 months? Oh, there's Trump tariffs. How am I going to deal with that for the next 9 months? Like, come on, man. Like, we got to be thinking about how we're going to build these portfolios for the next president, right? How are these companies going to perform for the next 15 years? past the current politicians, we'll have a whole new group in 15 years from now. Well, I don't know, maybe Congress won't, because that's a whole situation. But anyways, guys, you get my frame of thought here, right? Long term, think long term. Be invested into companies that you're confident in are going to do great for the long term, not just companies that might benefit for the next 6 months or 9 months or 3 months, or, oh, I got to stay away from this company because they might do bad in the next 6 months. Who cares? If you're going to do great over the next 6 years, pounce. Make it happen, okay?
Hey, it's Jeremy. I hope you really enjoyed that clip here today. Listen, there are 3 main areas a long-term investor has to understand. You have to understand financial statements, income statements, balance sheets, cash flows. You have to understand and master portfolio management. And you have to have the ability to project what is possible for companies in the coming years. Bearish scenarios, bullish scenarios. All these skills can be learned, and that's the good news. And I'm still just a regular guy who's out here. I just have a lot of passion for the market. I've learned a lot over the last 15 years. I had a tremendous amount of success, and I have a dedication to teaching people everything I have learned in the past 15 years. If I can do it, you can do it too. You can learn all that's required to become a great investor in my private group. The application is going to be down there in the description area. You can click on that, fill out an application, join us in the private group, get access to all my best course curriculums, teaching you everything that I got in my head, and you get ability to join our 6-figure, 7-figure Hall of Fame. We have such a tremendous Discord. It is incredible. So once again, description area down there, there's a link. You can apply to join my private group in there.
Next subject up here, small cap stocks, more hated than ever. Hedge funds' short exposure to the Russell 2000 stocks has risen to a record $20 billion. Over the last few weeks, bearish positioning has doubled, now exceeding the 2021 high. According to Goldman Sachs, hedge funds shorted $4.3 billion in small cap stocks between July 22nd and August 5th, the second largest 2-week amount in the last 10 years. As a result, the Russell 2000 has yet to hit an all-time high and is 9% below its 2021 peak. Small caps need help, right? So what does this mean? Like, what does this mean for small caps, the market, the state of the market, those sorts of things, right? I mean, my first thought is when they were shorting these stocks heavy, kind of, let's call it the end of 21 and the beginning of 2022, it was a great move. They made a lot of money on that. They should have made a lot of money on that. It depends on when they sold, or when they covered their shorts, right? But it was a good move. And so it's one of those things, it's like, could they be right again, right? Small caps are about to get hammered, let's say 2 months from now, 3 months from now, 5 months from now, something like that. It's possible. It's possible. But it's very different because at that particular time, small caps were running insane. The market was crazy euphoric. It seemed like everybody and their grandma was super, super bullish, right? We had extraordinary amount of money on margin considering where the stock market's value. If you ever want to know if margin's high or low, compare the market capitalization of the stock market to how much margin's out there as a percent. And at that particular time, it was a really high percentage was on margin, like relatively speaking versus other time periods. So we had that. We had interest rates that were pretty much at zero at that particular time, right? Now it's different. We've got likely a lowering of interest rates coming, right? The next cycle of lowering interest rates is on the doorstep. Could happen as early as this next month, right? September. So as a very different backdrop, inflation's not an issue like it was going into that situation. So there's a chance they could be wrong on this one. Maybe not. Maybe they're right? But I think there's a decent chance on this one they could be wrong. Like, small caps haven't done anything in years. Like, small caps have been dead for like 4 years now, right? And if anything, the backdrop for small caps looks like it should get better over the next 1 to 2 years, and certainly it's been over the last 1 to 2 years, right? So there's a chance they could be wrong, which could be interesting because that could produce incredible short squeezes in the Russell 2000 and in a lot of those small cap stocks. So is it once again something I want to play call options on because it might blah, blah? No. But I do own some small cap stocks, and would I be shocked if Wall Street ends up in a situation where suddenly they have to start liquidating short positions and have to start buying these stocks up? I wouldn't be surprised at all, man. So that's a tough call. Like it's, if I was to go against something in the market, I wouldn't be small caps at this stage, right? Like I can understand the move in 21, but right now, like of the things you could go short against if you wanted to short stocks or buy put options, you really want to do it against small caps? Like, I don't know, man. Like small caps haven't done anything in years. I don't know. That's a weird decision. I'll say that, okay? Berkshire Hathaway. So Berkshire Hathaway stock continues to just be a bad performer, right? And so this has kind of been a subject that's talked about here. There's a few things to factor in. One, Berkshire's heavily invested in Apple. Apple's been kind of a crap lagger stock of big tech, right? We all do know that. So that factors in. Warren Buffett's retiring, so it's not going to get as big of a premium. This is something I talked about years ago on the channel when I talked about Berkshire Hathaway. I said, when Warren Buffett retires, Berkshire Hathaway will get a re-rating of that stock. It's exactly what we're seeing play out. It happens whenever you got a legendary CEO, you end up getting a re-rating in your valuation, because basically when that legendary CEO is a CEO of a company, like people just pay a lot bigger price for it. Wynn Resorts had to go through it after Steve Wynn left, right? Like Wynn Resorts doesn't command the same, forward Ps and 2-year forward Ps that did under Steve Wynn. You're right. If you look at, like let's say Elon Musk left Tesla, like, oh my gosh, like could you imagine like how much that stock would go down in terms of like, the premium people will pay just because it's Elon Musk running the company, right? Berkshire Hathaway's facing the same exact fate. So that's something to factor in there. The other thing to factor in here at Berkshire is the business is just sleepy. It's just a very sleepy business. I mean, look at the numbers. Look at the numbers, you tell me. What do you see? I see a company with lucky to get single-digit growth. Single-digit growth. Trading at a forward P in the 20s, right? Like, it's just not a super attractive stock. It's not a bad investment. It's not a bad stock. It's just like, of all the options you have in the stock market, right? Because all these stocks are fighting for your money. Are you really going to go for the company that has low single-digit growth? Maybe best case scenario, mid-single-digit growth that's trading at a forward P in the 20s? That's a tough one, right? Additionally, I'm showing you right now the best stocks in the market the past 10 years, right? When I show you these stocks, do any of these stocks make you think of Berkshire Hathaway and Warren Buffett buying these stocks? No, they don't, right? There's none of those stocks like, oh yeah, Warren Buffett, he's a big investor in that one. Oh yeah, no, none of those stocks make you think of Berkshire Hathaway and Warren Buffett, right? And so, the way I kind of look at Buffett, I look at him like Michael Jordan, okay? So, for instance, if you know anything about basketball, you would respect Michael Jordan as like the greatest basketball player ever, right? Or if you don't have him number one, then you probably got him top 3 at least, right? But most people say, oh, Michael Jordan, the greatest basketball player in history, right? But let's be honest, if Michael Jordan was to step on a basketball court today, like he's getting absolutely wrecked by guys that are playing pickup basketball like LA Fitness or Lifetime Fitness, right? He wouldn't even like last a game. Why? Because Father Time is undefeated. Father Time is undefeated. Like him with that cigar and his belly, man probably tear his Achilles tendon before the game even got to the second quarter, right? And that's despite him being likely the greatest basketball player in the history of the world. And so Warren Buffett, I look at very similar. I respect him as the greatest investor ever, or one of the greatest investors ever, right? Legendary figure, but he's way past his prime. And it's really shown in the last 20 years, right? And so some people say, well, he still made money over the past 20 years. Yeah, but he should have made so much more money than he's made. Even looking back to some of the deals he was doing in the great financial crisis, right? He was doing some deals with Bank of America and other deals. Like he would have been so much better off just been buying stocks. Like he could have just bought the NASDAQ and made way more money than he did on a lot of those deals. I ran the math on them and I'm like, oh my gosh, like, people think just because you make money, it's good. No. You got to make more money than what the market's making you. That's the trick. And that's what makes you a great investor. To make you a great investor doesn't mean you make money. To be a great investor, that means you outperform the market significantly, right? And so Buffett, the man's in his 90s, right? Like he's just, my opinion is your investing prime is really 35 to 65 years old, right? So I'm 35 years old. I just entered my investing prime, right? And you've got that investing prime all the way to about 65 years old. After 65, Like, it's going to be harder and harder for you to understand business models, like new age business models that are coming out, things like that, right? Warren Buffett can tell you that himself. And it's going to be hard to understand the future. Also, there's just something that happens as a human as you approach 70s, 80s, where you just start thinking differently about risk. You kind of are viewing like your time running out, right? And it's just like the risk reward equation gets very skewed. Whereas in your 20s, you can make a lot of big mistakes potentially because you take too much risk, right? You're thinking so far in the future that you could make some big mistakes. That's why your investing prime is not in your 20s. On the flip side, your investing prime is not 86 years old either, because you're also thinking way too conservative, right? And if you look at Buffett over the past, really in the 2000s, as he exited his investing prime, right, and started getting to his 70s, 80s, nowadays he's in his 90s, he's made a lot of blunders, not in terms of like picking bad stocks, although he's had some of those. His biggest blunders really have come from like not taking nearly enough risk, understanding the next great business models, things like that, like he would have in previous generations, right, when he was really in his investing prime. Even when you think about the massive cash load they've built over the past 5 years, could you think of a worse time to build an insanely huge cash load than the past 5 years? I can't think of a time period since the 1970s where it would have been a worse time to build a huge cash load. Like, the dollar's been incredibly devalued for really the past like 5 years. So it has been a horrible time to build like this crazy cash flow that Berkshire has, right? And so, those are some kind of factors. And so that's kind of what I think is happening with Warren Buffett's stock and Berkshire Hathaway and things like that, man. Man's a goat, but, Father Time's undefeated. It's coming for us all. It'll come for me someday, right? You think I'm still going to be picking all these bangers when I'm 95 years old? I don't even know if I'll be alive when I'm 95 years old. But let's say I am still alive at 95 years old, hypothetically, right? Am I still going to be picking, the next Elf Beauty, the next Tesla, the next Palantir, AMD, all these stocks that I've been able to pick? No, give me a break. Like I won't be able to understand the business models on that sort of level at that particular time. We can all fight Father Time, but Father Time never loses a war. And it never will lose the war. It will always win, okay? We can fight it, and we can win some battles, but we're never going to win the war against Father Time, right? And so that's what's going on with Warren Buffett and Berkshire Hathaway, right? Now, fund managers. The fund manager survey came out here. Only 5% expecting a hard landing now in the next 12 months. Ooh, okay. So this is very interesting. If we look in recent, years, the only time we hit 5% is 2 times. One right here in June 2024, right? And then right here, January 2025. Now, this is fascinating because what happened about a month or two later is the market dumped, actually. It had a short-term, I would call it small correction type thing that happened kind of in this time frame, right? So that's interesting. And then we hit 5% right here, January 2025. And guess what happened? February 19th, market tops, and then down for the next several months. So you don't want to draw too many conclusions from this, but don't be shocked if we hit a short-term high for the market in the next 1 to 2 months and then have some sort of small correction or maybe major correction after that. Do not be surprised, okay? So that's what we can kind of read from this situation, right? Now, what adds some fascination to this, I actually texted this to a friend here today. I said, because I was watching some CNBC on the background while I was doing some work, right? And Dan Niles came out and he said, we're rally mode, baby. Rally mode in the market all the way to Turkey Day, all the way to Thanksgiving. And then he's talking about a 10 to 20% correction after Turkey Day. And I'm like, might happen. Like, I wouldn't be surprised at all if that was to happen, right? By the way, my X is always linked in the description area of all my videos if you ever want to follow me on X if you use it. I post quite a bit on there on a daily basis, okay? Now, in terms of, thinking about downside for the market, right? Let's say the market tops in the next month or two, right? And then we have either a small correction or a major correction in the market, right? Is this a good time to hedge? Here's what I'll say. It's not a bad time to hedge. VIX is at 16 right now, right? But I also don't think it's a great time to hedge. The best time to hedge usually is if you can get the VIX under 15, when we're talking about hedging through buying like put options or something like that, right? Because that's when usually people aren't expecting anything. So then if anything happens black swan-ish, small or big, it can actually shake up the market significantly because no one was expecting it. So the most ideal situation would be we bust to new all-time highs through September. VIX goes under 15, maybe into the 14 to 12 range. Boom. Add some puts as a hedge that expire mid-2026, and let's play a game, okay? So that's, if I could have it my way, that's the way I'll have it, right? Because right now I'm like, it's okay, but it's not my favorite time to hedge right now, right? And also, there's a lot of people that have been worried about August, September. Oh, the market might get shaky. Whenever everybody's worried, that's when I'm actually not as worried, essentially, okay? Now, what does this mean positioning-wise? Fund managers, cash levels, 3.9%, right? So cash levels have gotten really heavy at a few time periods, and one of those in terms of recent time periods was in 2022. Cash levels got really high, especially toward the end of 2022, essentially, right? Everybody was selling their stocks. They sold Meta under $100. Like we go through the whole list of them, right? So many of those stocks are now up 200, 300, 400, 500% plus from where they were back in 2022. But the moral of the story is it's just because fund managers are starting to get really low on cash, the gains are going to get harder to come by for now, okay? Because think of it as the percentage of cash fund managers have, think of it as energy, okay? And as the level gets lower, the energy is basically being depleted, right? The more cash fund managers have, like generally that means, at least in recent times, usually means pretty good things for the market. Like, look at my entire, this right here covers my entire investing life, right? I started end of '08 and all the way through to today, right? And so if you look, December of '08, man, cash levels are really high. That's actually a very bullish thing for the market over the next several years because that money will end up being deployed in the market, right? And it was. And then if we look here, cash levels insanely high, April 2020, right? That meant very good things for the market in the next few years, right? Cash levels insanely high, October 2022. That's when the market bottomed in 2022, right? And then ever since then, it's been a rocket ship ride. Cash levels started to get really high again earlier back in April, right? And then that led us to this recent rally where cash levels are down again, right? So I'll put it to you like this, like the little gym in my garage, right? So let's say I'm going to do some bench. I throw 135 on, right? And at first I'm repping it out. I'm like, oh, this easy peasy lemon squeezy, baby. There's nothing. Well, as I do more reps, I'm like, oh, crap, this is getting hard. Oh my gosh. And I'm doing rep after rep. Oh, this is getting difficult now, right? And eventually, it's like taking everything in me just to try to get that 135 up for one more rep, right? My arms are about done. That's what's going on at this stage of the game. We're now at a stage that we've been repping out for a while, and it's going to start getting really hard to get any substantial gains for the market from here. We need a rest. Rest is just a fancy way of saying or just a simple way of saying we need a correction in the market, right? And so we could maybe rep out a few more over the next month or maybe the next 2-3 months, right? But we need a rest. We need to put that bar up there and get our energy back again, right? And so, don't be, surprised if the gains get a lot harder from here and we eventually get that rest period, okay? So the energy's been very depleted now. We're on the last levels of energy now at this point in time, right?